China just planted a bomb in America's foundation, and most people have no idea it's ticking. For decades, the United States Treasury market has been the world's largest, most reliable, most liquid market on the planet. If you need to park $10 billion somewhere safe and know you can pull it out just as fast, there's simply no alternative. Buying US Treasuries has always been the smart move for other countries. But something's changing. In April 2025, the yield on 10-year Treasury bonds spiked in a way that shocked Wall Street. Market watchers knew what this meant. The biggest holders of American debt, China and Japan, were probably selling. And they were selling fast. This came right after President Trump and President Xi exchanged threats about tariffs. But here's what most people missed. China's been quietly reducing its Treasury holdings since 2022. Over that time, they've dumped roughly 28% of their position, dropping from over $1 trillion down to $730 billion. So, what's really happening here? Is China's bond sale just retaliation for Trump's tariffs? Or is this something far more calculated? And how will China's financial strategy reshape the entire global economy? Hold on. Before we dive into this research, I need to know something. Where are you joining from, and what time is it there right now? Country, city, local time, put it all in the comments below. I really want to see how global this is. All right, let's get into it. Since the middle of the 20th century, the United States has been the guarantor of safe investments. Once the dollar became the world's primary reserve currency, everyone felt comfortable putting their money into American securities. This was extremely profitable for America, too, because its budget kept growing while tax revenue couldn't keep up. So the United States kept issuing bonds, selling them to other countries for reliable dollars, and multiplying its national debt. By the end of 2024, America's debt exceeded $36 trillion. But as of October 2025, that number has climbed to over $38 trillion. That's $111,000 of debt for every single person in America. But here's the key detail. Americans owe most of this money to themselves. The Federal Reserve and other government institutions hold about 20% of all U.S. debt. American businesses and citizens control another 55%. Only about a quarter of that $38 trillion in government bonds belongs to foreign holders. China sits in second place on that list of foreign creditors, holding $730 billion in U.S. government securities. Japan holds first place permanently with more than $1 trillion. But why did China and Japan buy so many American securities in the first place? In the early 2000s, China's economy started developing incredibly fast. American, European, and East Asian companies opened factories or partnered with Chinese firms, and this allowed China to earn massive amounts from international trade. The country's reserves grew, and it made sense not just to hold that money, but to invest it to earn even more. That's exactly what China did. For years, they bought US Treasury bonds, mainly long-term ones because the yields were higher. Japan followed a similar path, but the relationship between the US and these Asian countries can hardly be called friendly. It's more like rivalry with a smile. And what are we seeing now? The yield on long-term 10-year bonds rose sharply in a short time, which doesn't usually happen. This means someone among the major holders of U.S. debt started aggressively selling their portion of bonds, and yields reacted accordingly. There's no official data on the amount of sales yet, but investors suspect China and Japan are dumping American government bonds as a way to fight back against President Trump's tariffs. You probably already heard the news. On April 9, 2025, President Trump imposed 100% tariffs on all Chinese imports. China immediately imposed retaliatory tariffs of 50% on all goods from the U.S. This raised China's overall tariff on American imports to 84%. It sounds insane already, But the story didn't end there. Trump raised US tariffs again to 145%. China responded by raising their tariffs to 125%. All of this happened in just 1 week. And here's where it gets really interesting. When Trump raised tariffs on China, he actually paused increases for several other countries. So it's obvious that China is being specifically targeted with deliberate pressure right now. And China didn't just respond with higher tariffs. They filed a complaint with the WTO, imposed restrictions on 18 American companies, limited exports of rare earth materials that are critically important for high-tech industries, and most importantly, they started selling US Treasury bonds. That's a pretty substantial response. But why did that last point scare investors so much? And how did the bond market end up having such influence, not only over interest rates, but also over the central bank, the stock market, and even presidential actions? The answer lies in the system itself. Most people think the Federal Reserve sets interest rates. But that's not quite right. The Fed controls short-term rates, but long-term rates like 10-year Treasury bonds are controlled by the market. That means by buyers and sellers. So if major holders of US debt like China start selling bonds, the Fed can't just stop it. And what happens to interest rates when bonds are sold off? They adjust upward because when bond prices fall, yields and interest rates rise. Sounds confusing? Let me break it down simply. Imagine you buy a bond with a face value of $1,000 and a coupon rate of 5% that matures in exactly 1 year. This means if you spend $1,000 today, in 12 months, you'll get that $1,000 back plus $50 on top. But if someone suddenly starts massively selling these bonds, the increased supply causes their price to drop, let's say to $900 per bond. Now, if you spend $900 to buy it today, in 1 year, you'll still get the face value of $1,000 plus those same $50 in coupon payments. For you, the yield to maturity on that bond will no longer be 5% like in our initial scenario, but over 16.5%. That's how much higher your total return will be compared to what you paid for the bond at its reduced fire sale price. So remember this. When people say bond yields are rising, it means the price of those bonds is falling. And conversely, falling yields mean increased demand for the bond and a rising price. Now imagine China and governments of other countries watching these events decide to sell bonds worth hundreds of billions of dollars simultaneously. What will this ultimately lead to? Even greater growth in US bond yields, meaning rising interest rates. And we've been observing this for the past month. This is extremely important because high interest rates make it more expensive for the US to borrow new money. And remember what America's debt is? $38 trillion. If interest rates continue to rise rapidly, this could force America to start cutting spending, which will definitely negatively impact the growth rate of the entire country's economy. So you could say it was actually the bond markets that forced Trump to do what he just did. Cancel tariffs for 90 days for more than 75 countries to avoid inflicting even more damage on the US economy. China wasn't on that list, though, which means the trade war continues. Tariffs were only relaxed on electronics, smartphones, laptops, and other devices. So it turns out that selling American securities really was a retaliatory response from China. But what about the fact that dumping Treasury bonds started long before current events? Remember that chart? Already in 2022, China's reduction of its US Treasury reserves was gaining momentum, but the whole world only paid attention in 2025 after the trade war began. Doesn't it seem like this isn't just about tariffs? What game has China started on the world market? There's one fascinating theory about this. Meet Scott Bessent, Treasury Secretary in the Trump administration. But he was famous long before this. In the early 1990s, Bessent and George Soros bankrupted the Bank of England. You know how they did it? At that time, Britain was part of something called the ERM, the exchange rate mechanism. It was a European agreement to maintain relative stability of exchange rates against the German mark. Britain wanted to keep the pound sterling in a certain price range, and to do this they had to defend it by raising interest rates or using foreign exchange reserves when necessary. But circumstances made their own adjustments. Britain's economy at that moment was weak. Inflation was rising, unemployment too. And most importantly, interest rates were already too high for the economy to handle. Then Scott Bessent and George Soros realized Britain simply wouldn't be able to keep saving itself with the same measures. They believed the pound's exchange rate was overvalued. Britain couldn't defend itself forever, and eventually the country would face a choice: either devalue the pound or exit the ERM. Guess what happened next? Soros and Bessent bet against the British pound. They borrowed pounds sterling and sold them, betting they could buy them back much cheaper later. Some reports say they bought pounds worth more than $10 billion. But all this was coordinated with other major institutions that saw the same opportunity. And when the Bank of England tried to defend the pound by raising interest rates and buying pounds with its reserves, George Soros and Scott Bessent just kept selling their pounds. Eventually, market pressure became too strong, and on September 16, 1992, Britain exited the ERM. The pound crashed, and that day became known as Black Wednesday. George Soros earned more than $1 billion on that trade, and it was Scott Bessent, who was working on Soros's team then, who was the key architect of this strategy. Now let's return to our time. Don't you get the feeling that Bessent is simply recreating a situation where a country has to choose between two very difficult decisions? Because essentially China now stands at a crossroads: weaken its currency or defend the yuan. In the first case, if China weakens the yuan's exchange rate, yes, this will reduce costs for its export industries and help offset the impact of Trump's tariffs. But this could also trigger panic inside China because it will inevitably lead to inflation, and investors will start pulling their money out of the country. Capital flight will begin. Money will flow into other foreign assets like gold, Bitcoin, or something similar. And from there, it's not far to destabilization of China's entire financial system. Agree, not the best solution. But there's a second option, which China appears to have chosen now. It involves maintaining a stable yuan exchange rate and defending the value of their currency by selling dollar reserves to buy yuan. But to get those dollars, China needs to sell US Treasury bonds, which is exactly what we're observing now. Now let's look at the situation again. From the outside, it seems China is just taking retaliatory measures against the US to show its disagreement. But in reality, they're doing this also to prevent the collapse of their own system, because they have no other way out. The only question is, how long China can continue defending its currency before it runs out of dollars to feed itself. On its side, China is also trying to figure out how long the US can withstand servicing its debts before it starts hitting their economy. After all, this year they'll have to refinance debt amounting to $9 trillion at the current very high interest rates. That's why we're seeing capital outflow from the US right now. Money is leaving the American stock market because investors fear for their investments and can't predict what to expect next. For both countries, this is a race against time that benefits no one. And if this really is Scott Bessent's strategy, then apparently he's trying to create a situation where pressure on both countries becomes so strong that they'll simply have to agree on something mutually beneficial. But the pressure just keeps building. In early October 2025, China escalated things further by imposing sweeping export controls on rare earth minerals. These materials are absolutely critical for everything from smartphones to military equipment. And China controls roughly 70% of the global supply. On October 10th, Trump responded immediately, announcing an additional 100% tariff on all Chinese goods, set to take effect November 1st. That's on top of the existing 30%. He also threatened export controls on critical software. The stock market crashed on the news. The Dow dropped nearly 400 points. The S&P 500 fell over 1%, and the Nasdaq tumbled almost 2%. Just days before, Trump had suggested canceling his upcoming meeting with President Xi, saying there seemed to be no reason to meet anymore. But here's where it gets interesting. Treasury Secretary Scott Bessent quickly walked back the threat, saying negotiations are back on track and the tariffs don't have to happen. Trump and Xi are scheduled to meet in South Korea on October 30th. The trade truce between the two countries expires on November 10th. So right now, as you're watching this, both leaders are racing against the clock. Will they strike a deal, or will the November 1st deadline trigger another devastating round of tariffs? But how will these financial games affect the entire world economy? Global supply chains will be disrupted, especially in high-tech industries, and this will slow innovation and increase costs for manufacturers around the world. Rising tariffs will lead to increased prices for consumer goods in many countries. Inflation will grow, and global economic growth will slow down. The International Monetary Fund lowered its forecast for global growth in 2025 from 2.8% to 2.2% due to current trade tensions. World stock markets are becoming extremely unstable, and this reduces investor confidence. In early April, Asian stock markets lost 7 to 13% in trading. In Germany, trading started with a 10% collapse. Key stock exchange indices lost record values. And so far, it feels like the US and China are moving toward economic decoupling. That means America and China will completely stop trusting each other's money and split into two separate economic systems. What do you think? Is this possible? And which scenario for further events seems most realistic to you? Write your thoughts in the comments. Thanks for watching till the end. If you're here, you're one of those who want to understand how the financial system really works. Subscribe, new research tomorrow. And drop a comment. What do you think about this? Your perspective matters.